InvestSMART's separately managed account benefit number 10. From 5,000 to 50 million and beyond, everyone is able to take advantage of our outperforming investment team. We aim to take away the barriers to entry when it comes to investing, be it through the language we use when writing our recommendations to the minimum start investment amounts. Investing is for everyone, you just need to start. For more information, visit investsmart.com.au or download our new app.
Hello, I'm Tony Kaye, I'm the editor of Eureka Report, and today I'm talking financial planning with Carol Tawfik, one of our financial investment commentators.
Hi Tony, good to be with you.
Hi Carol, thanks for coming in again.
Pleasure to be with you.
Now, today I wanted to have a chat about people in their 50s, where they are in terms of the context of investment and estate planning. What are the things that people should be considering in that age group? So people in their 50s, they're pretty much in the run-up to retirement, I suppose.
Yeah, and I think certainly superannuation becomes a core part of one strategy in their 50s. I think in the years leading up to, you're very sort of much focused on building your career, perhaps paying the mortgage, dealing with school fees and those sorts of things. So I think once you enter into your 50s and retirement perhaps is on the horizon, superannuation and maximising the use of super starts to become a real core part of the strategy.
Would you say that people in their 50s, they should really be looking at doing more salary sacrificing into super and trying to allocate as much as they can?
I think so. And look, again, it depends on the circumstances around other liquid assets, because of course funds that are contributed to superannuation will be subject to preservation. So whilst we're getting closer to retirement at that age, we still need to bear in mind the need to have liquid funds outside of superannuation. So salary sacrifice is a great strategy in terms of an immediate tax benefit, but also of course in terms of maximising the use of that potentially tax-free space. So that is likely to be, you know, a strong part of what one should be considering in their 50s as they near that time that superannuation can be accessed and the preservation becomes less of an issue.
I guess one of the things we're seeing is that the retirement age is actually creeping out as a result of changes.
Correct, yes. So the time in which you will be able to access superannuation is stretching out, which means that we need to just adjust our thinking a little bit to ensure that there are sufficient other funds that can be drawn upon, and that anything that goes into superannuation, we're clear that it cannot be accessed until, say, 60 or whatever it might be.
In terms of investment strategy, people, I suppose, tend to get a little bit more conservative sometimes as they get older. Is that a mistake for people in their 50s?
I think it's completely understandable. I think at that time you're feeling that there is less time to recover losses using your income. You're feeling that I will only be working for 5 or 10 years, so I need to pull back on the risk because I have much less time to recover if there was a loss or something along those lines. So I think that's quite understandable. The psychology of that I understand completely. I would also say, however, that the investment time horizon is still likely to extend into the long term. We often think about retirement as this line in the sand, but of course your superannuation and your investments will carry on beyond retirement even if you are drawing upon them. So we still need to think that there is indeed a long-term investment time horizon, and this point of retirement isn't some line in the sand. So I do certainly understand the feelings of wanting to be a little bit more conservative, but we just need to keep that in the context of the big picture.
Yeah, and of course a lot of people continue working well into their 60s, sometimes even longer than that. So, it's really much keeping that time horizon in focus.
Absolutely.
Yeah. And what about in terms of estate planning? What are some of the things that people should be looking at in their 50s?
Look, I think certainly it's important to review wills and insurances periodically. Again, when it comes to wills, a lot may have changed in terms of family circumstances, children, partners, those sorts of things. So I think it's important to ensure that reviewing wills and the overall estate plan is included in the financial management in your 50s. Insurances also possibly requiring review as you've accumulated assets over time. It is potentially possible that the large sums you might have insured for in your 40s are potentially not required to that degree as you've accumulated other assets and you have the ability to self-insure. Completely case by case, of course, but those two items certainly should be part of the review and the thinking at that time.
So there's quite a lot to do, I suppose, and it makes sense to probably do a financial health check, fairly frequently to see where you are in terms of your total retirement savings, where you are in terms of your estate planning.
Absolutely, and I think research has shown that people do mainly seek advice in their around age 50 to 60, which is, of course, a great time to be reviewing things. But I certainly can't help but think, if you were to start a little bit earlier and get a cohesive strategy before that, you'd be on a really solid footing going forward and more so reviewing rather than necessarily overhauling the strategy at that time.
Yeah, I agree with that. It makes sense to do it along the way where you can.
Absolutely.
Yeah, well, thanks for joining us again, Carol.
Pleasure.
I'm Tony Kaye. I'm the editor of Eureka Report. Join us again next time.